When you think about retirement, most people imagine a number, a balance, a portfolio, or a figure that sounds comfortable enough to make life easier. But the truth is, retirement is not just a number. It is a state of mind. It is peace. It is freedom from the constant tension that comes from chasing wealth instead of cultivating stability. And yet, so many investors, even those with decades of experience, unknowingly buy into habits, products, and illusions that quietly erode that peace. They are drawn not by necessity, but by marketing, by habit, and sometimes by emotion. If you want a peaceful retirement, the first lesson is simple. Not all purchases are neutral. Some quietly steal more than money. They steal calm focus and the ability to plan long term. Over my years observing investors and reviewing my own mistakes, I have identified 5 categories of things that, when bought or invested in impulsively, tend to disrupt financial peace. Understanding these will not make you wealthy overnight, nor will it make headlines, but it will protect your future self, preserve your confidence, and allow the quiet accumulation of security that truly matters. 1. Avoid overcomplicated financial products. Financial innovation is relentless. Every year, banks, brokers, and advisors introduce new products that promise higher returns, greater protection, or both. Structured notes, derivatives, exotic insurance plans, leveraged funds, and other complex investments often appear on glossy brochures or in polished presentations. On paper, they look attractive. The allure of higher yield, tax efficiency, or market-beating performance is seductive, particularly in a world where everyone is chasing growth. But the deeper lesson, one I've seen repeatedly among retirees, is that complexity often hides risks you cannot fully perceive until it is too late. Early in my career, I encountered a structured investment that sounded brilliant. It had formulas, thresholds, and embedded options designed to appear both clever and secure. The salesperson presented it with charts, scenarios, and forecasts that made the product seem sophisticated but safe. I was impressed, even excited, yet I did not fully understand how losses could compound under certain market conditions. Theoretically, the upside was enticing, but practically I had no real control, no complete understanding, and no margin for error. Over the following years, I watched friends and clients lose significant sums, not because the market itself failed them, but because the product demanded a level of knowledge, judgment, and attention that most average investors could not reliably provide. The complexity created a hidden risk, silently eroding financial security. This pattern is remarkably common. Every extra feature, every innovative twist, every exotic structure requires mental bandwidth. And mental bandwidth is finite. The more complicated a product becomes, the harder it is to monitor, understand, and manage effectively. When we trade clarity for cleverness, we trade peace of mind for the illusion of control. Retirement of all periods in life is not a time for experimentation. It is a time to rely on structures you understand, instruments that behave predictably, and systems that quietly support your life, rather than demanding constant supervision. The consequences of complexity go beyond potential financial loss. They also carry a psychological cost. Investors who use overcomplicated products often find themselves stressed, second-guessing decisions, or obsessively tracking every variable. Small fluctuations become sources of anxiety. Mistakes are magnified. Even when the investment ultimately performs reasonably, the mental energy expended in monitoring it can outweigh the benefits. The peace and clarity that come from simple, understandable strategies are difficult to reclaim once lost. Simplicity, by contrast, offers predictability. Broad index funds, diversified bonds, and consistent contribution plans may seem dull in a world fixated on excitement and novelty, but they perform a unique and essential function. They compound steadily over decades. They allow investors to focus on the bigger picture rather than being consumed by the intricate details of each product. Predictability is not glamorous, but in retirement planning, predictability compounds into security. It allows you to make decisions with confidence, to plan without stress, and to enjoy the freedom your working years have built. A simple portfolio is also resilient. Complexity can amplify risk in ways that are invisible until a crisis hits. Structured products may work fine during stable market conditions but behave unpredictably in a downturn. Leveraged or exotic instruments can magnify losses faster than an investor realizes. The more you rely on clever strategies you do not fully grasp, the higher the likelihood of making a mistake at a critical moment. In contrast, simple investments offer a level of transparency that allows for easier decision-making, better assessment of risk, and more consistent returns. Ultimately, the lesson is clear: complexity is a hidden tax on peace. It may promise higher returns or clever advantages, but it rarely delivers sustainable security. Retirement is not a time to chase excitement or innovation. It is a time to protect the wealth you have earned and to allow it to serve you predictably. Anything that threatens consistency, introduces hidden risk, or consumes mental bandwidth is a threat to the peace you will need when your working years are behind you. True financial wisdom lies in choosing clarity over cleverness. It lies in understanding the instruments you own, knowing how they behave, and relying on strategies that perform steadily over decades. Excitement may be tempting, but it is fleeting. Consistency is enduring. By avoiding overcomplicated financial products, you preserve both your capital and your calm, ensuring that retirement is a period of security, freedom, and confidence rather than stress and uncertainty. 2. Stop buying lifestyle inflation. It's human nature to enjoy the rewards of our labor. When we earn more, we want to live better. A raise feels like a license to indulge. A newer car, a bigger house, a luxurious vacation, or even subscriptions to every service that promises convenience or entertainment. At first glance, these purchases seem harmless, even justified. They are markers of success, visible proof that your hard work is paying off. Yet, beneath the surface, lifestyle inflation quietly undermines long-term financial security, often without people even realizing it. Consider the story of a friend I met in his late 40s. For decades, he had approached retirement planning with discipline. He contributed steadily to his retirement accounts, diversified his investments, and generally maintained a thoughtful approach to wealth. On paper, everything looked solid. But over a period of just 5 years, his portfolio seemed to stagnate. Curious and a bit frustrated, he started analyzing the situation more closely. What he discovered was telling. It wasn't a bad market or poor investing that had slowed his financial progress. It was his own behavior. Each time a bonus arrived, each time a raise came through, he allowed his lifestyle to expand just a little more. The new car didn't feel extravagant. The larger home seemed reasonable. The exotic trips were framed as well-deserved rewards. Individually, none of these purchases appeared threatening. Taken together, however, they quietly consumed the very margin that his retirement security required. To maintain this upgraded lifestyle, he found himself taking on additional market risk, chasing higher returns to support higher expenses, and slowly eroding the buffer that had once given him confidence. The lesson here is subtle but critical. Retirement planning is not simply about accumulating assets. It is about controlling obligations. Every recurring expense you take on reduces flexibility, narrows options, and adds stress. True financial security is less about the size of your paycheck and more about the freedom to make choices without constraint. A smaller mortgage or fewer luxury commitments may feel like a sacrifice in the short term, but they provide a cushion that makes volatility in markets or unexpected life events far less frightening. This is not a call to deny pleasure or live frugally to the point of misery. It is about distinguishing between purchases that provide genuine, lasting value and those that merely satisfy fleeting desire. Ask yourself, does this purchase enhance my life in a meaningful way, or am I buying the illusion of status, comfort, or happiness? The difference may be subtle at the time of purchase, but it becomes profound over the long horizon of decades. Lifestyle inflation works subtly. Each incremental expense feels manageable, almost trivial. Yet over years, these small increments compound. A $500 monthly subscription, a slightly bigger mortgage, a few more dinners out. These expenses quietly grow into obligations that dictate your choices, tethering your financial future to your current lifestyle. When markets turn volatile, health costs increase, or unexpected opportunities arise, these obligations can feel like chains. The freedom you sacrifice for short-term gratification cannot easily be regained. There is also a psychological component at play. Humans are wired to compare, to measure success against peers. The temptation to upgrade when others do, or to reward yourself for accomplishments, is strong. The challenge is recognizing that financial freedom, true independence, is measured not by what you own, but by the options you preserve. In essence, every dollar spent on unnecessary upgrades is a dollar that could have expanded your freedom and security. The most effective approach is mindful spending. Set clear boundaries for lifestyle upgrades. Prioritize experiences, education, or purchases that deliver lasting benefits. Avoid the trap of keeping up with societal expectations or peers whose financial decisions may not align with your own long-term goals. Learn to savor rewards without letting them dictate your obligations. Over time, this discipline compounds in ways that investment returns alone cannot replicate. In the end, the choice is simple but powerful. You can continue chasing incremental upgrades, feeling successful in the moment, while silently risking the stability you've worked decades to build. Or you can resist the urge to inflate your lifestyle, protect your margin, and preserve the freedom that allows you to navigate life on your terms. One day, when markets wobble, health challenges arise, or meaningful opportunities appear, the flexibility and peace that come from living within your means will be far more valuable than any fleeting joy purchased through indulgence. True wealth is not defined by possessions, it is defined by the freedom to choose, the ability to act without constraint, and the confidence that comes from controlling your obligations. Avoid lifestyle inflation, and you safeguard not just your finances, but your future freedom. 3. Avoid speculative hot investments. One of the hardest lessons for investors to absorb is that chasing quick gains often destroys long-term peace. Every year, headlines scream about the next hot stock, the crypto project promising overnight fortunes, or the financial product everyone seems to be talking about. Early adopters are celebrated, their profits highlighted as proof that being bold and fast pays off. What the headlines rarely show, however, is the quiet suffering of those who arrive too late, who invest impulsively, or who buy without fully understanding the risks. Speculative investments are seductive. They appeal to our desire for quick success, to beat the market, or to feel clever. The psychology is compelling if everyone else is talking about it. If someone made a fortune seemingly overnight, shouldn't you act too? Yet this impulse often leads to pain rather than profit. I have met retirees who, in their pursuit of higher returns, allocated portions of their nest egg to speculative ventures. At first, the results were thrilling. Portfolio values surged, pride and excitement filled the room, and the sense of being ahead reinforced the behavior. But this euphoria was short-lived. Volatility followed. Losses appeared. Sleepless nights replaced the thrill with anxiety. Even modest stakes in unpredictable investments can steal more than money. They steal focus, confidence, and the mental space required to maintain a steady long-term plan. Speculation, in this sense, is a tax on peace of mind. It turns what should be a deliberate, predictable journey into a roller coaster of hope and fear. Every sudden market swing triggers emotions that make rational decision-making nearly impossible. Anxiety, doubt, and the pressure to act all mount. And investors find themselves reacting to noise rather than following reasoned strategy. True financial progress, particularly in retirement planning, is quiet. It compounds steadily year after year. A reasonable return earned consistently over decades often far outpaces sporadic brilliance or lucky wins. To understand why this matters, consider the difference between investing and gambling. Investing is a patient, disciplined process, built on understanding the underlying value of assets, the sustainability of earnings, and the reliability of cash flows. Gambling, or speculation, relies on timing, luck, and often incomplete information. Markets, by design, reward patience, not cleverness. Those who chase hot opportunities rarely realize that the moment they buy into hype, they are often buying at the top. Gains may evaporate faster than they appeared, leaving behind losses that could have been avoided with discipline. I've observed a recurring pattern among investors drawn to speculation. The excitement of potential gain blinds them to probability. When the market moves in their favor, it reinforces the belief that they were right. When it moves against them, panic sets in and rational planning is abandoned. The cycle repeats. Over time, the emotional cost accumulates. Confidence is eroded. Even after losses are recovered financially, the psychological impact lingers. This is why speculation is far more dangerous for retirees or near retirees. The stakes are not only financial but personal. Retirement is not a game of who can guess the next trend. It is a period of life that demands stability, predictability, and clarity. The antidote is simple but difficult in practice. Resist the allure of hot investments and commit to consistent, sensible strategies. Focus on diversified quality assets that compound reliably. Understand that small, steady returns add up significantly over decades. Avoid the temptation to react to every market story or headline. Markets are not contests of cleverness. They are systems that reward patience, discipline, and the courage to do nothing when the world demands action. Timing is rarely worth the stress. A portfolio that grows steadily without dramatic swings will likely outperform one that attempts to chase brilliance but succumbs to volatility. The moment an investment seems too good to be true, or everyone is talking about it, pause. Evaluate whether it aligns with your long-term goals, risk tolerance, and ability to sleep at night. If the answer is anything but a confident yes, it is a signal to step back. Remember, financial success is measured over decades, not weeks or months. Speculative investments often promise excitement and recognition, but they come at a hidden cost. They convert what could be a calm compounding journey into a constant cycle of anxiety and overreaction. The path to real financial security, especially in the context of retirement, is built on calm, steady decisions, not on chasing trends. Every time you resist the pull of hype, you preserve mental clarity, protect your nest egg, and give your investments the chance to grow in a predictable, sustainable way. In the end, the greatest power an investor has is patience, the ability to wait, to follow a disciplined plan, and to resist the noise of speculation is what separates those who enjoy financial security from those who are forever chasing fleeting excitement. Markets reward consistency, not cleverness. Wealth is built quietly, steadily, and without drama. Avoiding speculative investments is not about fear. It is about preserving peace, clarity, and the freedom to make meaningful choices when they truly matter. 4. Stop buying debt. It is deceptively easy to accumulate, yet almost impossible to enjoy fully without cost. It promises something today, a new car, a bigger house, a luxurious vacation that must be repaid tomorrow. Often repayment comes with interest, sometimes compounding silently, creating obligations that grow faster than many people realize. Mortgages, credit cards, personal loans, and car financing may each have their place, but every borrowed dollar carries a hidden cost, a cost to your freedom, your peace of mind, and ultimately your ability to make choices in retirement. I once met a retired couple who seemed, on paper, financially comfortable. They owned a home, had some savings, and had contributed to retirement accounts steadily over the years. Yet, for decades, they quietly struggled. Their mornings were consumed by the management of debt, paying bills, tracking balances, negotiating interest rates, and worrying about unforeseen expenses. Evenings offered little reprieve, often filled with restless thoughts about what might go wrong next. Their assets could have supported them comfortably, but the weight of debt overshadowed every potential benefit. The reality is that their money, which should have served as a tool for freedom and security, had become a chain that dictated their daily choices. The psychological effects of debt are often as damaging as the financial ones. Borrowing can create a false sense of security and even a temporary thrill, the excitement of a new car or the satisfaction of a home upgrade. Yet this feeling is short-lived. Anxiety, regret, and the pressure of repayment soon take over. The mental space that could have been devoted to thoughtful planning, enjoying life, or pursuing meaningful experiences is instead consumed by worry. Debt silently erodes confidence, self-control, and the autonomy to make choices without constraint. Managing debt requires discipline, foresight, and sometimes sacrifice. True financial freedom in retirement is impossible without addressing it. Every dollar borrowed reduces flexibility, limits options, and adds stress. By contrast, paying down loans, avoiding high-interest borrowing, and living below your means preserves autonomy and empowers long-term decision-making. Small sacrifices today, delaying a luxury purchase, committing to a repayment plan, or declining a tempting loan, compound into decades of calm, confident living. It is important to distinguish between productive borrowing and destructive debt. Productive borrowing, such as a modest, well-structured mortgage on a home you can comfortably afford, can support long-term security and even build wealth. Destructive debt, such as high-interest credit cards, multiple personal loans, or financing luxuries that outpace your income, does the opposite. It siphons away both resources and peace of mind, creating stress that accumulates quietly over years. Debt also has a cascading effect on other aspects of financial planning. Every obligation limits your ability to invest, save, or take advantage of opportunities. Imagine the couple mentioned earlier. Had they avoided unnecessary debt, they could have directed more funds toward investments, enjoyed greater flexibility, and taken fewer risks with their nest egg. Instead, the burden of debt forced them to compromise, creating a cycle of stress and financial uncertainty. The more debt accumulates, the fewer options exist for handling emergencies, health issues, or unexpected life changes. In retirement, where flexibility and stability are most needed, this can be devastating. The lesson is clear: debt is not merely money owed. It is the quiet erosion of autonomy, and autonomy is the foundation of a peaceful retirement. The power to choose how to live, when to act, and how to allocate your resources comes directly from minimizing obligations and managing what you owe. Every loan avoided or repaid strengthens freedom, confidence, and control. Building a retirement life free of unnecessary debt requires intentionality. It requires evaluating every purchase, every financial decision, and asking, does this enhance my life in a meaningful way, or does it bind me to obligations I may regret? It requires the courage to delay gratification, to prioritize long-term peace over temporary enjoyment. The payoff is immense, a retirement where wealth serves you, rather than where you serve the obligations debt imposes. In the end, financial security is not about how much you earn or accumulate. It is about how well you control what you owe. By stopping the accumulation of unnecessary debt, living within your means, and prioritizing repayment of high-interest obligations, you preserve the most important asset of all, autonomy. This autonomy allows you to make choices freely, navigate challenges calmly, and enjoy retirement with confidence and peace. Debt may promise today, but freedom and true financial security requires restraint, discipline, and a commitment to live below your means. 5. Avoid over-diversification into confusing assets. Diversification is often praised, and rightfully so. It protects against catastrophic risk and smooths returns over time. But over-diversification, especially into assets you do not understand, can be just as dangerous as concentrated risk. Owning dozens of accounts, funds, and asset classes may give the appearance of sophistication, but it creates complexity that erodes clarity. One investor I met had 20 different investment vehicles across multiple countries and asset types. He spent hours tracking, rebalancing, and worrying. The result? He was exhausted, anxious, and frequently tempted to make impulsive trades to simplify temporarily. His returns, ironically, suffered from both distraction and overactivity. The principle here is subtle but essential. Complexity does not equal protection. Simplicity, when executed with discipline, produces both clarity and resilience. Your goal should be to own a manageable number of instruments that you understand, that reliably produce reasonable returns, and that do not demand constant attention. Every added layer of confusion is an added source of stress, a potential trigger for mistakes, and a subtle thief of retirement peace. The overarching lesson: these 5 categories, the complex products, lifestyle inflation, speculative investments, debt, and confusing over-diversification, share a common theme. They reduce freedom, erode confidence, and create unnecessary anxiety. Retirement is less about wealth accumulation and more about preserving mental space, maintaining control, and ensuring that your decisions today align quietly with your needs tomorrow. I have learned and observed that financial peace is built not through excitement, cleverness, or occasional brilliance, but through consistent, deliberate choices. Habits matter more than headlines. Predictability matters more than applause. The ability to ignore the noise, to automate contributions, and to allow time to compound returns without interference is more valuable than chasing every opportunity the market offers. Consider your investments as you would a garden. You do not dig up the soil each week hoping for faster growth. You plant, water, protect, and then let time work. You do not accelerate the seasons, and you do not demand miracles. Your role is steady, quiet, and disciplined. The same principle applies to retirement investing. Another important dimension is emotional identity. Many investors tie self-worth to market performance, to the thrill of discovery, or to social validation. This is particularly dangerous when buying the things described above. Confidence borrowed from a winning trend or a successful purchase is fragile. It depends on external outcomes. Confidence built from discipline, patience, and reflection is durable. It survives volatility, setbacks, and inevitable mistakes. Mistakes themselves are inevitable. Everyone makes them. The key is that the mistakes we allow to persist, the ones that grow silently unnoticed in the background, are the ones that threaten peace. Buying unnecessary products, inflating lifestyle, chasing speculative returns, accumulating debt, and overcomplicating portfolios are all mistakes that compound slowly, quietly, and often without immediate notice. Over years, they accumulate into stress, regret, and diminished freedom. A peaceful retirement does not require brilliance. It requires restraint, reflection, and the courage to say no to things that seem exciting but do not serve long-term goals. Every unnecessary purchase is a vote against patience. Every impulsive investment is a vote against calm. Every addition to debt is a vote against autonomy. Over decades, these votes accumulate into a life that either supports you or constrains you. Building peace through choices to achieve peace, one must first observe oneself without judgment. Notice patterns of impulse, fear, or comparison. Reflect on how purchases, financial or otherwise, affect not only balance sheets but mental state. Then, slowly, deliberately, replace harmful behaviors with disciplined habits. Contribute steadily to accounts that compound reliably, keep expenses below means. Even when income rises, avoid speculative bets that create unnecessary anxiety. Manage and reduce debt. Proactively simplify portfolios to instruments you understand. Each action seems small, almost trivial. But over decades, these small habits compound into a robust sense of security and calm. The difference between a peaceful retirement and a stressful one is rarely about returns. It is about alignment, patience, and quiet control over one's financial life. If you are nearing retirement or even in the middle of your career, take a moment to reflect. Ask yourself, are my purchases serving my future peace or my present desire for excitement? Are they reinforcing discipline or quietly undermining it? Are they simple and manageable or complex and distracting? A peaceful retirement is not built by chasing the next hot product, upgrading lifestyle unnecessarily, speculating for excitement, accumulating debt, or diversifying into confusion. It is built by doing less, deliberately, consistently, and with understanding. Wealth is not measured solely by numbers, but by the confidence, freedom, and calm it creates in your life. The greatest lesson I've learned, and the lesson most retirees discover too late, is that financial peace is not an accident. It is the outcome of thoughtful decisions repeated over years. It is the quiet accumulation of small habits, disciplined choices, and the courage to avoid temptation. It is patience, humility, and respect for time, your most valuable ally. If you stop buying the things that steal peace, you allow time, consistency, and simplicity to compound. Your retirement becomes not just a number in a bank account, but a life that feels secure, flexible, and free. That is the true reward of careful, thoughtful, and patient investing.